Coming up today, where Goldman Sachs thinks we go next, a look underneath the hood of the market, what happens if NVDA rolls over, consumers continue to weaken, how to crush inflation, bond market seasonality, Putin extends an olive branch, Elon Musk's crazy claim, and the group of stocks currently having a fire sale. Good evening, good morning, good afternoon, wherever you are in the world. Thank you very much for tuning in here today. And as always, let me get you updated really quickly on where all the major markets are, giving you the bird's eye view of what's happened today. S&P 500 pretty much finishing flat, tech leading the way once again. Nasdaq slightly breaking out to new all-time highs again. However, once again, we've got deteriorating breadth. Russell 2000 breaking out to monthly lows. Volume breadth also down near the low end of the range. Amount of stocks above their long-term 200-day average, actually breaking down to a multi-month low today, along with new monthly lows for stocks making new highs on both the NYSE and Nasdaq, along with a bit of a breakout and stocks making new lows, again on the Nasdaq as well. A little bit different for a Friday is the VIX popped up, finishing up over 5% at 12.6. Bit of an increase in volatility risk premium as well, pushing up to monthly highs. Correlation index super low at 9.4. Bond market volatility picking up, along with a sharp increase in the skew index, price of out of the money put options. Bond yields finding a little bit of support, but still had a really big down week there, even more so on long duration. There's a 10-year at 422. And so the real question in markets now is the bond market just pricing in a soft landing where the economy and jobs market just cools enough to bring inflation down and allow the Fed to cut rates while business profits can keep on expanding? Or is it pricing in something a bit more dire? We'll take a look at all the data a bit later on. However, for now it is helping bonds break out. There's TLT, risk-sensitive bonds, high-yield corporates falling a bit here today, still above the 50-day. And normally with the pullback in bond yields, we'll see the dollar pullback as well. However, bit of volume coming into dollar index futures there and holding up pretty good, and what could be a bit of a safety rotation trade there. It's another big measure of risk sentiment, really weak here. Bitcoin sitting at the 50-day VWAP. We were thinking it was just about to break out to all-time highs. However, we've had a sharp pullback in risk breadth, and even though the dollar rallied today, so did gold as well, and potentially a little bit of a flight to safety as well. And there's crude oil still hovering around the 50-day. There's a look at Apple putting in the fourth consecutive reversal signal, peeling back a little bit today. Microsoft pretty much trading flat, but starting to look overbought. And NVIDIA then a whisker of overtaking Microsoft, less than 50 billion away from becoming the biggest company in the world. Almost got there today. However, I'd say there's a good chance that'll happen next week. So putting all that together, again, just a continuation of my thoughts yesterday. Short term, we're looking a little cooked here. Could be getting close to a short-term top. DSI's overbought. Second reversal candle with a lot of overbought signals on the big tech stocks, which are really driving the main indices higher. However, medium-term and long-term trend is still intact. We just have very soft market breadth. However, looking at the options market and volatility, they're not too worried about anything bad happening just yet. But stick with me because I'll come back to the charts a bit later on. First, we'll move on to some data research, the latest news and events, along with my reactions to them. And before I continue, just a quick reminder, if you find value in these videos and you'd like to show your support, then just go ahead and click that like button and you'll be doing me a huge favor as well. So thanks very much for anyone who takes the time to do that, and let's dive right into some data. So I just gave you a quick look at the here and the now and the short term, market internals, different key markets, but just stepping back, S&P 500, now 329 trading days, has done a decline of 2%. One could make the argument we are officially in a low volatility regime that can potentially go on for some time, which funnily enough we saw last in the mid-2000s, prior to that the mid-90s, prior to that the mid-1980s. Here we are in the mid-2020s. Could we get another big, long-lasting, low volatility regime market? Well, to start this year off, it's been super strong. In fact, we're having the best first 114 trading days start to any election year in history. Prior best election year for S&P performance year to date for the same time was back in 76. Market's almost up 14% year to date. And just looking back in history, every time we've been up this amount or more. For the rest of the year, if we're only up a little bit more than this, most of the time we finish positive. However, if we get too overcooked to start with, we can usually finish a bit negative. So if the market keeps ripping up over the next few weeks, we're going to be up in this zone here where things will start looking bearish for the rest of the year because we've brought forward too much of that election year average gain. And there's good fundamentals driving the gains in the stock market, namely analyst EPS revisions higher. Big driver of stock prices, with one of the most important investment banks, Goldman Sachs, lifting their S&P 500 year-end target at 5,600 based on strong EPS growth and an increased fair value PE. And there's a look at a chart of where they think the S&P will finish the year at. So we closed today at 54.31. They're thinking we're going to trickle up only about another 3% also higher to 5,600. However, they've also shown 3 other scenarios. Just in case we get a recession, they think we could be staring down the barrel of a 4,800 handle. If we get the rest of the market catch up with the mega cap tech leaders, I think we'll accelerate up to 5,900. And if we go into a true speculative mania bubble, which they've labeled mega cap exceptionalism, they think we could hit 6,300 by the end of the year. And so mega cap tech have been flying higher, not just in stock price, but in their earnings as well, a lot faster than the rest of the market. However, earnings growth is expected to broaden out going into the rest of the year. In fact, the fourth quarter this year, S&P 500, excluding Magnificent 7 stocks, earnings growth is expected to outpace that of the Mag 7. And just looking out to next year in 2026, S&P 500 median earnings growth expectation is set to increase and significantly narrow the gap between the mega cap tech and the rest of the market. And the overall estimate for what analysts think the market's going to make this year and next year has been increasing the last couple of months, with analysts expecting the S&P 500 to make about 279 points in earnings per share next year. And if you just take a calculator with the current S&P at 54.31, divide that by 279, gives us a forward PE of about 19.46, which is pretty reasonable. It's not absolutely crazy. Typically, it's really expensive when it goes over 21, 22 on forward PE. So if the market can keep growing earnings and they do broaden out, then just on that measure, things are not that crazy just yet. But why they appear this way right now is thanks to this guy, Jensen Huang, and his company NVDA, growing leaps and bounds over the last year or two. Revenue, earnings, margins, market share, and finally market cap, now eclipsing that of Europe's largest economy, Germany. And some saying NVIDIA is really holding up the market here. I guess there is some truth to that, looking at the breadth here and now. S&P and NASDAQ ripping higher, while the rest of the market really peeling back. So is it a case if NVIDIA rolls over, then the market gives out? Or could it be a case of a massive rotation, NVIDIA rolling over and the rest of the market doing some catch-up with money rotating out of big tech into other parts of the market that have kind of been left behind and starting to look a little cheap, especially relatively speaking. Because just looking underneath the hood at another measure of market breadth, looking at sectors' relative performance versus the S&P 500 since September last year, they're pretty much all down except for 2 sectors: communication services, which holds stocks like Meta, and IT, of course, big large tech. Every other sector relatively to the markets really dived, especially lately in financials, industrials, and energy, really been soft versus the market. And just looking over the last month, that divergence has accelerated even here in the short term, with tech out in the blue, the rest of the market trading pretty heavy and soft here, even dipping down this week. Here's another chart to visualize that divergence. Going back to January 2020, top 10 stocks in the S&P versus the bottom 490, the biggest gap we've seen in over 4 years. And so that's creating a pretty interesting environment to investors and the opportunities in front of them currently and what to make of it all. Just looking at the forward PE ratios of large cap, mid caps, and small caps, taking out 2023 and the prior bear markets, forward PE on small caps pretty much as low as it's been over the last 17 years, and a huge gap between the valuations on large cap. In fact, small caps are the least expensive versus history on half of metrics, looking at the valuation premium discount. Small caps here in the dark blue, large caps in the yellow, and just looking at the relative forward PE of small versus large as well, around the same levels we saw back in the late 90s. And this is a chart I've showed in the review before, and it's a few months old. However, it's even more relevant now because this spread has widened further. It's the earnings yield spread of small cap value, historically the best performing type of stock in the long run, versus large cap growth, is now at all-time highs. That's only occurred less than 1.7% of the time, and in the following 10-year periods, small cap value has returned 16.8% a year more than large cap growth. And there's a look at the daily spread chart of the Russell 2000 versus the S&P 500. Just got my 3rd consecutive reversal signal on the spread. DSI are really oversold here. And so even in the short term right now as I speak, small caps are really oversold and cheap versus large caps. In fact, you could almost call it a fire sale in terms of technicals and valuation differences. And there's a long-term monthly chart of the spread between smalls and large, getting really oversold here as well, even taking out the 2020 lows. And just so like I showed you with the data, earnings are expected to come back on the rest of the market. These huge earning growth rates we're getting from big cap tech may go on for a few more quarters yet. However, I'd be very surprised if we're still getting these out of the park numbers in a year or two from now. And of course, we could still go into a recession potentially next year. However, if I just overlay this chart with recessions and just looking at how small caps have performed against large caps, well, going into a recession can have a sharp sell-off. However, coming out, small caps are the best place to be. Early stage recovery, and they're not always weak in rising unemployment environments either. There's a look at how small caps versus large caps performed in the global financial crisis, going into it in 2008. We actually came out of it in mid-2009 higher than where we started. And for a big part of that 2008, small caps actually ripped up into the peak fear of the market. In fact, if I just overlay the VIX chart, you can see there's correlation. During that times of fear and distress and panic, when the VIX shot up to almost 100, small caps significantly outperformed large cap, and they went on to a few more years of outperformance. And same deal in the last recession we got prior to the GFC, early 2000s. Small caps rode it out just fine the whole time and even went on to rally for a few more years as well. So here we are now, a lot of people betting on large cap growth. The biggest stocks in the world going to keep getting bigger, which very well could continue weeks and months further. However, I'd make an argument that small caps versus large caps are closer to a bottom than a top, technically and fundamentally, looking at valuation differences. And just to be clear, this is relevant to long-term investing, but if you're similar to me and like to use indicators to help buy the dip in the short term in the context of a long-term trend or play, then now looks like a pretty good time to add to position in small cap funds or even small caps themselves. You can still find good quality businesses trading on a PE of 10, healthy balance sheet, and some that aren't so cyclical to big swings in the economy either. And just moving on to the economy and looking at a bit of the macro and data. Another sign today that consumers are softening. University of Michigan's Consumer Confidence Survey declined to 65.6, down from 69.1 at the end of last month and well below economists' expectations, actually thinking we're going to get an increase to 71.5. And so that pullback in oil hasn't really got consumers feeling as good as what some thought they would be. And what's interesting, even though we've been getting some good inflation prints of late and market expectations of inflation coming down significantly, consumers' expectations of inflations are actually going the other way and staying at elevated levels for their 5-year inflation expectations, even higher than back in 2021 and 2022 when we really got an outbreak in inflation. And looking at current economic conditions, in a bit of a sharp fall off this month as well after last month's fall. And so once again, got some soft economic data out there. And the Fed's just calling for a few more good inflation prints before they can cut. And I think that's the case as well. You get a couple of good more CPIs, PCEs, things like that. Just looking at the price action in the bond market, looks like we're setting up for a cut in September. And who knows, still possible they may even cut next month. Since we do have all levels of government calling for a cut, and I think the Fed and AAPL will be happy to trade a little bit of inflation for the chance for the US government to refinance a bit of debt at a lower rate. However, just keep in mind, you should always take what the Fed says with a large grain of salt, as most of their projections actually don't come true. Way back in 2008, when Ben Bernanke authored the first quantitative easing program, said back then, we're just doing this in response to the global financial crisis until we stabilize credit markets, grease the wheels of the economy, then we're going to taper it off, bring it back down so we don't have so much artificial money floating around the economy. Well, we got a little bit of a European debt banking crisis, so they decided to do quantitative easing version 2. Then they did what's known as Operation Twist, where they sold a lot of short-term bonds and bought long-term ones in order to try and lower long-term bond yields and stimulate economic activity. They gave up on that. Then even though things were pretty much fine, 2013, 2015, VIX was rock bottom, stock markets were grinding higher, decent economic growth, they decided to come out with a massive quantitative easing version 3. And every time in the projections where they'll taper off, which they did a bit in the years of 2018, 2019. Then late 2019, they actually started to increase their balance sheet a bit to get ahead of some potential banking problems. And then of course COVID came in and they just shot their balance sheet into the stratosphere, printing a record amount of money never seen before in mankind. Got their balance sheet to 9 trillion, markets hit all-time highs, along with inflation to 40-year highs, realized they had to pull it back, and recently they've just tapered off their decreases. They were doing 95 billion a month, now they're doing 60 billion. And does anyone out there really think this time's different and they're not going to do a quantitative easing version 5 the next time we get the slightest hiccup in the economy or markets? Well, when you've actually got people in the top 1% club determining how much fake money they want to print because it actually benefits themselves. Jay Powell was actually using Fed money to buy municipal bonds and other things that he actually owns himself, being worth over 100 million. Even some of his mates at the Fed were trading around Fed decisions. They knew they were going to pump the markets with liquidity. They loaded up their own personal accounts. They knew the Fed was going to taper and raise rates. They sold out of their stocks. That got leaked out to the public. Jay Powell had to let a few of his mates go at the bank. But anyway, I digress. My point is the top 1% are going to keep doing what the top 1% do. And that's artificially inflate markets, which is largely to the benefit of them and their cohort at the expense of pretty much everyone else below having to pay a much larger portion of their salary for basic goods and services, thanks to huge structural inflation that was inevitable after this much money print, not to mention rock bottom interest rates overstimulating the economy as well. And they'll always come out and say, oh, it's out of our control, supply side constraint, Vladimir Putin, or just be totally vague about it. And like J-Powell is a great wordsmith at convincing you it's anything but the Fed and the government, or the government at large. And if you want to see what's possible when you do get the right government in there that cleans up things, does what's actually logical in favor of the people, then just look at Argentina's inflation rate. Completely out of control. At the end of last year, 25.5%. In came Milei, cleaned things up, significantly decreased government spending, even flies economy class himself when he's going to visit other leaders around the world, slash budgets, stop handing out money, cleaning up corruption, and what a surprise, inflation's already coming down big time. So the point is, government and leaders can really bring down inflation if they want to. However, to do that, just like cleaning up anybody's finances, you have to first start with living below your means. However, that's unlikely to happen anytime soon, and just looking at the Fed's summary of their economic projections, the difference between their June and March projections, still expecting the economy to grow 2.1% this year. Unemployment, they think, is going to not move at all and stay at 4%. Core PC inflation actually increased, along where they thought their own overnight rate will be at the end of this year and the end of next year, along with the longer run. So it's interesting, we've been getting these soft inflation prints at the same time the Fed increased their inflation forecasts, maybe taking advantage of these falling bond yields to jack up their forecasts. They don't really want to do that when yields are ripping higher, adding fuel to the fire. And so just watching markets every day and going over data and news, it feels like there's been a bit of a regime shift in the bond market, really pulling back on yields sharply. Just looking at the 2-year, still a bit early to say whether the market's just getting excited of the prospect of a soft landing, or is it something deeper. Could say this is a bit of a topping pattern, if not consolidating. But like I said, we need to take out some key supports for the market to really start showing signs that things are getting worse in the economy at a rapid pace. And it's true, if we do get some more good inflation prints, the Fed could surprise, maybe cut in July. If not cut in September and December like the market's forecasting, then the bond market rally may have further to run. We've already got a little bit of short-term momentum in bonds breaking out to monthly highs. And just looking at one of the most popular bond funds, TLT seasonality, average of all years it's traded, currently going into a really bullish period for the next 50 days of trading, about 2.5 months. And there's a look at the daily on TLT, but just going out to the weekly, expanding the chart, could be getting to the end of a stage 1 accumulation after it has been in that stage 4 decline bear market for almost 4 years. In fact, the longest and deepest bear market in US bond in their 250-year history. At a big bottom in October last year on huge volume, come back down and retested about the midway point. Looks like we may have found support again, and one could argue we're actually breaking out above this trend line, and this could actually turn out to be a bit of a double bottom. And quite often with double bottoms, you won't see the second bottom line completely up with the first bottom. It can actually bottom out a bit early or sometimes a little bit later and create a big divergence. However, technically, it does look like the bond market is breaking out here. And just looking at the 50-quarter and 100-quarter moving average of the 10-year Treasury yield, we are a bit above that. So a bit of short, medium-term reversion to the mean could see us come lower. Let's just keep in mind the 200-quarter moving average still materially higher, around 6%. And can you imagine a world with a 10-year Treasury bond at 15%, like they were back in the early 1980s? It's where the bond market had to go to really topple inflation back then. Hopefully, we don't see the same thing again. And on to commodities. Oil bouncing back from last week, softness, and holding its ground against the excess supply. And just looking at electricity, over the last 4 years in the state, actually up over 30%. And this could accelerate going forward thanks to the huge electricity demand, data centers holding all the servers and GPUs, powering artificial intelligence applications. We just also heard from Vladimir Putin offering some conditions for which he's willing to start peace negotiations with Ukraine and end the war. And I'll just play you exactly what he said now, and then I'll give you my reaction to it.
Эти условия очень простые. Украинские войска должны быть полностью выведены из Донецкой, Луганской народных республик, Херсонской и Запорожской областей. Причем, обращаю внимание, именно со всей территории этих регионов в пределах их административных границ, которые существовали на момент их вхождения в Украину. Как только в Киеве заявят о том, что готовы к такому решению и начнут реальный вывод войск из этих регионов, а также официально уведомят об отказе от планов вступления в НАТО, с нашей стороны незамедлительно, буквально в ту же минуту, последует приказ прекратить огонь и начать переговоры. Повторю, мы это сделаем незамедлительно. Естественно, одновременно гарантируем беспрепятственный и безопасный отвод украинских частей и соединений.
So is he really extending the olive branch and being genuine and wants peace? Or is he trying to plant a Trojan horse? Some say his requests of Ukrainian territory are unacceptable, including Zelensky. Says he's not willing to negotiate, doesn't want to give up any land. That could definitely be up for debate on both sides there. He's also requesting Ukraine don't join NATO, which he was originally promised all along from both sides. In my opinion, what really instigated Putin to go into Ukraine is to try and prevent that, as he sees Ukraine as kind of the younger brother of Russia. They share the same blood. Many Ukrainians speak the Russian language. They share a long and close rich history together, and just the timing of this too, going into the US federal election. Maybe he's trying to send a message to the world that he wants to talk peace, he wants to stop it. Just after we got news, the Biden administration is approving US weapons to be used inside of Russia. So maybe he's trying to position Biden and Zelensky as not wanting to talk about peace, make them look bad, potentially lose political support. However, for now, it appears Putin is willing to come to the table. Maybe this is his starting point for negotiations. Maybe if Trump gets back in, he can broker a deal where Ukraine don't join NATO, but they don't have to give up so much land back to Russia either. And as much as that'll be to the dismay of a lot of people, like an old saying is, a good result to a negotiation is when everyone's left upset and you all meet in the middle, and that could very well be a better alternative to being taken to the verge of World War III. Anyway, for now, it doesn't look like there'll be any peace talks held anytime soon. Moving on to one of the other most controversial people I talk about on this review, Elon Musk, coming out with a bold call today saying Tesla could be worth 30 trillion thanks to AI and robotics, which he thinks those businesses will exceed that of the electric vehicle. And these big calls certainly get people talking amongst Elon's legions of lovers and haters, and a lot of people just call him crazy, stroking his ego or whatever. I think there's a deeper play, similar to Roaring Kitty, with these big bold calls. He's doing his job as a CEO, trying to attract investors in the stock, keep them invested, keep a lofty valuation, so there's more optimism than pessimism spreading throughout the company. Also sets lofty expectation for his partners and employees, and just gets people talking about him, like the old saying, any PR is good PR. And this is not the first time he's come out with these crazy calls. In fact, back in early 2015, Tesla could be worth 700 billion by 2025. CNN called him insane. So he says a lot of bold things, but he may have just outdone himself as he thinks the stock will go into insane mode. Well, actually turns out he was right, and he was right by 5 years. Hit 700 billion in the year 2020. And I know people either love him or hate him for whatever reason. However, who knows? Could be right. We've already seen Optimus bots do things, and look at this, fixing this thing right by itself here. It's already at this level in his own factories, and the Optimus bot could actually be a big product in the future, along with full self-driving, and who knows what else, AI and robotics, they can slap the Tesla brand on. And there's a look at the price action today, peeling back a bit after yesterday's gap up, on news that shareholders once again approved him for his promised compensation package, meeting all the milestones initially set out to him. Current market cap, 567 billion, big divergence from the rest of the mega cap tech, who are all $1 trillion club now. So moving over to GameStop, no fresh updates from Roaring Kitty. Still looks like he's holding a bit over 9 million shares, which now actually makes him the 4th largest shareholder on the register. And I think maybe Ryan Cohen could already be considering inviting him onto the board of directors. I think they should get him in there as a brand ambassador, help with social content. I think that could really help out the entire company, not to mention all their own positions in it. And like I said, don't underestimate a cult. We're already getting guys posting on Reddit tattoos of Roaring Kitty on their leg. Got a whole army of investors and followers who are following him on this and staying with him on this. And price action reasonably flat in shares today. 28.70, just above where GameStop was able to sell 75 million new shares to the market early this week. French stocks have been getting hammered this week as we're getting big political shifts happening in Europe, with right-wing parties coming back in multiple countries. In polls and at the voting booths, there's been a rise in nationalism, aligning with political parties that are taking a firmer stance on loose immigration. And for now, that's got markets a little worried. There's French stocks selling off hard this week, also bringing down the entire Euro Stoxx 50 index as well, currently at oversold levels. And it's not just Europe that's weak. Got weak global equity breadth. Canada's TSX, UK FTSE underneath the 50-day, there's Germany's DAX, China 50, the Nikkei 225, and the Aussie 200. All looking a little different than the S&P 500. And just to look out to next week, slow start on Monday. Tuesday we'll get a look at some retail sales and industrial production data. Wednesday the market's closed in observation of Juneteenth holiday in the state, the 19th of June. Then coming back on Thursday, got some housing data, jobless claims, finishing out the week with some PMIs. There's a look at the economic calendar today. Inflation data in France actually coming a little hotter than expected. And just looking at month-over-month changes in import prices and export prices in the States, a lot lower than expected. Another good sign for inflation here and now. And there's the consumer sentiment survey coming in a lot worse than expected. Fed Fund futures still pricing in about a 70% chance we cut in September. Fear and greed index, huge divergence with the market thanks to that breadth, and corporate insiders still just doing about average level of selling. All right, guys, we've gone a bit into OT here, so I'm going to wrap it up. We've already pretty much gone over every major market category, all the market internals, and just looking at that along with global equity breadth. And the big one, NVDA, which is on the cusp of becoming the largest company in the world. That's probably going to happen next week. It's going to be interesting to see when NVIDIA eventually pulls back along with other mega cap tech. Is that going to roll over the rest of the market with it? Or will we see a rotation into the rest of the market that has already been weak for a while now? Because I'd say the consensus out there, especially looking across financial social media, and just like that meme I showed you with NVIDIA holding up the whole market, the wide held belief is that when NVIDIA rolls over, the whole market's going to roll over. However, looking underneath the hood, the market has already rolled over a bit. Russell 2000. And like I said, for the here and now and long term, small caps are super cheap versus large caps. Maybe the spread will actually stabilize when NVIDIA and others roll over. As always, we'll see what happens and do our best as to what to make out of it all. Thanks very much for tuning in. Have yourself a great weekend. Look forward to making you another video come Monday night. Cheers.